everybody knows the whole pre-1971 thing where we had the dollar backed by gold, the rest of the currencies were pegged to the dollar, and that broke down in 1971 because we no longer had enough gold to support that. And then so for a few years, we were kind of in the state of limbo where a global financial structure was somewhat in limbo. It was unclear. And in 1974, the U.S. kind of salvaged this by making deals with Saudi Arabia and the rest of OPEC and said, okay, so you guys are big oil exports, so we want you to only sell that oil in dollars. So regardless of which country you're selling it to, only sell it in dollars. And even better, take those dollars and go ahead and buy treasuries and use them as your reserves. And in exchange, we'll provide protection. We'll do lucrative arms deals, and we'll help keep shipping lanes open, things like that. And so we shifted from, say, the Bretton Woods system to, for lack of a better phrase, the petrodollar system, with kind of that 3-year gap there. And so from that point on, any country that needs to import oil needs dollars.
Okay.
And so we've kind of created this global demand for dollars in a somewhat different structural way than existed prior to that period. And so the U.S. became a big exporter of dollars, which essentially means we became a structural trade deficit country. And so that was a big shift from before that time. And so, for the past, say, 40 to 50 years, the United States has turned to this big kind of almost semi-permanent trade deficit situation where we just send tons and tons of dollars out to the world. Our exports are, in many cases, less competitive than they used to be, whereas our import power is very strong. And so we shove all these dollars out into the world, and then the rest of the world takes those dollars and then buys, for lack of anything else to do with the dollars, they go ahead and they buy U.S. assets. So they used to buy treasuries a ton. They really slowed that down over the past decade, but they still aggressively buy, especially U.S. equities, but then also U.S. credit and U.S. real estate. And so we've kind of engineered this 4-decade kind of structural U.S. bull market situation with as much capital as possible kind of being shoved into U.S. markets. And so the biggest theme over the past, say, 40 years, in addition to the whole bond bull market theme that's kind of been structural, is this shift towards the United States running these structural trade deficits, sending dollars to the rest of the world, and then the rest of the world taking those dollars and then reinvesting those back into U.S. assets. And so we've had this kind of, secular bull market, this period of U.S. outperformance. And there are some decades where we were not the biggest performers, but for a 40-year stretch, we've really kind of dominated equity markets. But that does not come without costs. And so it's kind of I would describe it as kind of the biggest question in macro is how much stickier or how much longer lasting can this kind of engine of U.S., say, capital market outperformance continue.
Let's move on to the next chart. And you says the title is "The World Buys the U.S. Assets."
Yeah, so what this chart shows is U.S. equities held by the rest of the world. So the foreign sector's ownership of U.S. equities. And so in addition to owning some U.S. treasuries, so they're a creditor to the U.S. government, they also own corporate bonds, they own U.S. real estate, but really the United States is kind of known for its deep equity markets. We've got by far the largest kind of capital markets in the world, and especially with this kind of 4-decade engine in place, we've attracted as much kind of capital to our markets as possible, and this shows the parabolic increase that we've had from the rest of the world owning U.S. assets. And this kind of it started off decades ago. The rest of the world owned maybe 5% or less of U.S. equity markets, but now it's more like 25 to 35%, depending on what source you're looking at. In 2020, we saw a big the United States did more fiscal spending, had a larger percent increase in broad money supply than most other countries, so we saw a pretty big dip in the dollar. In 2021 has been more the story of kind of sideways consolidation, where there's been less extremes, and I think part of that has to do with timings around the virus and things like that. And so, obviously in the past few months we had the Delta variant that particularly hit Southeast Asia, for example, whereas the United States was, for a little while less hit by that. We also saw, obviously, China did this giant crackdown on its equity markets, And so it's one of those things where a lot of capital seem to have just fled to U.S. Equity markets as opposed to these other things.
You know what I find kind of interesting about this is you hear all these stories about how China needs our dollars and China's on the ropes, and then you look at this and they're actually China's a creditor.
Yeah, they are a creditor. It's actually that's the thing about the way this works and why there's like a feedback loop where, there's that statistic from the BIS that says that the rest of the world owes $13 trillion in US dollar denominated debt. And the tricky thing is most of that's not owed to the US. It's actually owed to other countries. So a lot of US debt is ironically owed to China. They take some of their dollars from their trade surpluses and they lend them to countries in Africa and South America and Eastern Europe and things like that. So that's one. And then two, so they have all this dollar liability, different countries, but then the rest of the world owns something like 40 or $45 trillion in US assets. And so if they ever come up short for dollars, like if trade dries up due to something like COVID or a recession, and they suddenly need dollars, they can sell U.S. assets to get dollars. And so we saw that happen back in say March 2020, where we had that dollar squeeze, and so you started to see the foreign sector selling treasuries in order to get dollars, and so that forced a feedback function where the Fed had to come in and just do $1 trillion of QE and buy $1 trillion of treasuries in 1 month to kind of reliquify the market, and it hasn't stopped yet. Around World War I and then World War II, the United States became the world's largest creditor nation. And that was part of how we kind of ascended to that place as kind of the global superpower. And then for several decades, we coasted on that and kind of maintained that strength. But then, with the creation of that petrodollar system, and then especially with some of the 1980 policies, we started basically drawing from that reserve. And so we, by running these structural trade deficits, what that does, the way that countries build up positive net international investment positions over time is by running, many, many years of trade surpluses. And so the other way around is if you run many, many years of trade deficits, your assets are increasingly owned by the foreign sector because they take, you're shipping dollars to the rest of the world in this case, and the foreign sector is taking those dollars and buying U.S. assets. So we're kind of increasingly giving, big percentages of our companies, of our government debt, of our real estate to foreign entities. And so this shows the rapidly deteriorating net international investment position of the United States. And so essentially what we've done is we've kind of thrown the blue collar workforce under the bus. We've kind of said we're going to kind of de-emphasize our industrial base. We're going to do a ton of labor arbitrage. We're going to run these big trade deficits, and that's going to cycle back into our capital markets and really kind of prop up those equity markets.